Welcome to Enjoy the Journey podcast, where we interview expert entrepreneurs and thought leaders to help guide you in pursuit of financial freedom. Presented to you by Jackson Milan, the Wealth Mentor, and Sam Panetta, the Money Man, where we help service-based business owners remove cash flow bottlenecks, maximize their profits, and turn business profits into personal wealth. G'day guys, Jackson Milan, the Wealth Mentor here, and we're here for another episode of the Enjoy the Journey podcast. And today we're going to be covering off the subject of having a simple strategy as an entrepreneur. The common mistakes, the common traps that many business owners make when it comes to turning their business profits into personal wealth, and how you can leverage this time of year, the end of the financial year, to start planning for your next 12 months, to have the most successful 12 months in business and wealth creation that you've ever had. So let's get started. Now, I've worked with thousands of clients over the years, and I've come to see that there's some really big mistakes that people make when it comes to creating their own wealth strategy. Particularly as a business owner, particularly when we've started a business from scratch, we tend to condition ourselves that our business is the be-all and end-all of our existence. We pour all of our blood, sweat, and tears into the business. We do everything that we possibly can to make sure that our business is successful, right? Because at the end of the day, our success is directly linked to the success of our business. That's where our best hours are spent. It's where the best returns are achieved. It's ultimately going to result in whether we are financially free or whether we struggle through our life. And I agree with this 100%. I believe that as an entrepreneur, your primary objective should be to grow and scale your business. But there are some significant pitfalls that many of us fall into that lead us astray, can set us back years, if not decades, from achieving financial freedom. So what I want to cover off today is why you need a simple strategy when it comes to your wealth journey. And I find that there's entrepreneurs that fall into typically one of two traps. I'm going to cover them today. I'm going to talk to you about how I fall into some of these traps myself, how I've learned from my own mistakes, and hopefully how I can transfer my mistakes, the things that I've learned, to help you avoid having to make the same mistakes for yourself. Now, there are two types of entrepreneurs in my experience. There are entrepreneurs that are serial fence sitters when it comes to their own personal wealth. They believe that their business is the primary vehicle that is going to allow them to achieve their goals. We've already covered that off today. I agree with that 100%. However, they continue to reinvest into their business and back into their business and back into their business. And before they know it, all of their eggs are in one single basket. Their business. There is a fundamental issue with this, guys. And this is something that ultimately results in many of these entrepreneurs never achieving financial freedom in any case. They've ultimately become the one thing that they've been working so hard not to become, is the polar opposite of being financially free. And there is a reason for this, and I'm going to run you through this today. The second party is the super aggressive entrepreneur. The super aggressive entrepreneur is typically somebody who is treating absolutely every single aspect of their life as if it is maximizing the value like they do in their business. They're constantly trying to trade the share markets and do property deals that allow them to manufacture wealth, whether it be property developments or renovate for profit or subdivisions or whatever it might be. They are constantly trying to be involved in everything to do with their wealth. Now, this might seem like a good idea, but what this ultimately means is that because they're trying to do absolutely everything, they're not doing anything right. And I've seen many entrepreneurs lose hundreds of thousands, if not millions of dollars in wealth as a result of being a jack of all trades and a master of none when it comes to their money. Now, what is the issue with these two different personas? And the issue is that they are both at extremes. One does nothing when it comes to their own personal wealth creation. They're constantly focusing on doubling down on their business, expecting that their business is just going to continue to grow and they'll come back to building their wealth later. Or worse yet, they're relying on having to sell their business to achieve financial freedom. And we've covered this in the past, guys, that there is less than 6% of businesses that are ever sold for a profit, if they're ever sold at all. Now, I'm not a gambling man, but those aren't good odds to me. And on the flip side, the entrepreneurs that are constantly trying to actively manage every single aspect of their wealth, they're actually missing opportunities. They're likely missing opportunities in their business. They're missing opportunities in their wealth. And this ultimately leads both of them astray. Now, we need to talk about, firstly, the big picture, the importance of wealth creation when you are a business owner. We need to ensure that we have a system for turning our business profits into personal wealth. And the reason for it is we've spoken about this before, that business is inherently risky. We're taking a risk every single day when we get out of bed. There is no guarantees, particularly through this coronavirus crisis, and we've barely seen the start of it. We've just been announced that we're in a recession for the first time in nearly 30 years. There are going to be a lot of businesses out there that aren't future-proofed, that are at substantial risk, and are ultimately not going to survive to tell the tale. So it is imperative that we ensure that we hedge our bets and that we diversify, that we do everything that we possibly can to use our business as a platform, as a vehicle to advance our position in pursuit of financial freedom, so then we can defend ourselves from the potential downturns in the economy that could send our business into the abyss. Now, wealth creation is typically something that many entrepreneurs put off far too long, and it's normally because of self-limiting beliefs. They don't believe that they can take that money out of their business. They're going to cause it harm. They don't believe that they can pay themselves that level of income because they don't have enough margins. They don't believe that they can take that profit because they need to hire more staff. They need to buy more stock. They need to do whatever it is that is the next project in their business. They believe that they can't take the money out of their business to allow them to do that. And I call bullshit. In my experience, this is one of the most significant limiting beliefs in the mind of a business owner. The fact that a business that they have created does not have the ability to fund their own personal ambitions. Now, don't get me wrong, there are many successful business owners out there that have hugely profitable businesses that do this very well, but I believe that they are the minority. The majority of business owners are a slave to their business. They are a slave because they work countless hours, they put in so much effort, and they get very little reward in exchange. And we want to flip the switch on that. We want to ensure that business owners can get what they deserve and have the ability to manufacture and create wealth outside of their business to achieve financial freedom. So there is a big importance of having a wealth strategy outside of your business. And the reason why many of these business owners have this belief is because they do not have a North Star that they're following. We spoke about this in the last podcast that we did, that we spoke about the importance of having that real roadmap. But once we've got that roadmap, we need to turn that into a wealth strategy so we can crunch the numbers. That we have a really clear-cut plan of how much we need to be taking out of our business, what we're going to do with that money we take out, and essentially be able to have that mapped out in advance so we can make objective and straightforward decisions that are timely and allow us to be able to craft the wealth that we need to achieve those goals. Now, the problem for most is that they don't have that wealth strategy in place, and that's why they fall into one of those two buckets. The first bucket being the one that sits on the fence. They go, it's too hard for me to create a wealth strategy. It's going to take too much of my time. I'm just going to stick to what I do every day. I'm going to double down on my business. It's what I know. It's what I'm going to continue to do. And then on the flip side, the aggressive entrepreneur is constantly trying to leverage the same strategies that have most likely led to their success in business and exhibiting those same strategies and behaviors to try and do the same in every other aspect of their life. And it's exhausting. Every person who is hugely successful in an area of their life is because they dedicated themselves to mastering that craft. Whether it be entrepreneurship, whether it be creative pursuits, whether it be inspirational speaking, whether it be property development, whether it be trading the share market, whatever it may be, I expect that that individual is an expert because they specialized. And the reality is that you can only actively manage your wealth if you specialize, if you are willing to invest 5 to 10 years of your life in pursuit of wealth mastery, if you want to actively manage your wealth, and you need to treat it like it's a business. And the reality is that for many of you, that's not going to be an option. You are better spending that time in your business. Now, you're probably thinking, Jackson, that sounds a little bit contradictory. You're saying that I should focus on my business. So what do I do with my wealth? Well, I'm going to show you exactly how we do this. But firstly, I'm going to tell you a story. Now, in my younger days when I was working as an advisor, I thought that I was a guru when it came to investing. I was building portfolios. I was researching the markets. I was picking stocks. I was doing everything that I possibly could to try and outsmart the market. And for a very long time, I thought I had. I'd been successful. At this point, I was trading my own money, and I had a similar strategy for my clients, but not as risky, whereby we built portfolios of managed funds and exchange-traded funds, where we reviewed them on a quarterly basis. For myself, I was managing my own portfolio daily. And I thought I was onto something. I thought it was so smart. I was getting profitable days, day after day. I was exiting at the right times. I was buying at the right times. I thought I could see trends. And the reality was that I was just very, very lucky. Now, there came a day where I went into the office. It was a Friday. It was in December. And I'd been successfully trading my own portfolio for probably 12 months. And I was getting probably 3 out of 4 calls right, which meant that I was hugely profitable. Now, we had this meeting. It was on a Friday, and every Friday we'd have a team meeting. And I used to trade from my phone. And I had alerts set up on my phone that if anything changed, it'd ping, and it would keep me informed. Now, we had these open positions. We were going long on a series of stocks. We went into this meeting, and midway through the meeting, my phone just started pinging like crazy. I pulled my phone out of my pocket. I looked down at my trading app, and the market was plummeting. Here I am trying to exit my positions. It was too late. Market had bottomed out, my trading account had bottomed out, and all of my holdings had gone to zero. You see, at the time I was trading CFDs, contracts for difference, derivatives that don't provide you with actual ownership of the stocks. And with this, it means that there is no intrinsic value in what you're trading. You are basically betting against the direction of a market. And my bet was wrong. Trading account goes to zero, nothing left to show for it. Now, I was lucky. I had stop losses in place, which basically meant that I was paying a premium and insurance policy that meant that my trading account couldn't go anything less than below zero. If any of you have been following the news recently around the recent volatility in the stock market, you may have heard the recent flash crash of investors investing in a similar way. There was a young fellow in the United States that's trading account went to negative 750,000, and he unfortunately committed suicide. Now, I wanted to say this, that there is no loss that should cost you your life. One of my mentors once said to me, there is one thing that nobody will ever take away from you, and that is your ability to earn an income. So even in the face of adversity, even if you make an investment that seems like the world's come to an end, just know, no one can take your ability to earn that money back away from you. It's not worth ending your life over. Now, at the time for me, I had my heart sunk. It was devastating. I'd lost a huge amount of money. And unlucky for me, I had to start from scratch. Now, this was because I thought that I could use the same strategies that I'd used to grow and scale my business to grow and scale my wealth. And the issue was that I wasn't comparing apples with apples. This was a huge mistake on my part. I thought that I could be smart, and I thought that I knew what was going on, and the reality was that I was just incredibly lucky. Now, as an aggressive entrepreneur, you want to manufacture wealth, and I hear you. I'm all about that. However, you need to make sure that you are completely aware of all of the rules of the game and completely aware of the time required to do this. Because here's the thing, right? If you're devoting all of your attention to your business, if you are managing your clients, driving your marketing, improving your sales, streamlining your delivery, building a team, all of these things take a lot of time, right? So how can you possibly think that you're going to have enough time to actively manage your wealth? You just can't. And this is the same fear that the fence sitters have, because they have this fundamental belief that wealth is not something that can be passive. And I assure you it can be. I was lucky enough to learn this lesson very, very early. And I was able to develop an investment operating system that we've used for our clients for nearly a decade now. And over the course of the last decade, we've helped our clients build $1.2 billion in wealth. And it's with a very simple turning your active income into passive wealth strategy. And I'm going to show you that you don't need to get sexy when it comes to your wealth. And there are 3 tiers to your wealth strategy that will ensure that you take the appropriate level of risk based on your life stage. And as you advance your wealth position, that we can turn things up. We can take a bit more risk. And we can do so with peace of mind and certainty, knowing that we're not going to jeopardize our future planning as a result. So a wealth strategy. What is a wealth strategy? A wealth strategy is an objective framework that we refer to as the investment operating system that allows you to know where you should be putting your money, when, and how much. It is directly related to your real roadmap, the 20-year roadmap that you can define of all of your lifestyle and financial goals over the course of the short, medium, and long term. And when reverse engineered, it gives us 3 key considerations. Firstly, how much do we need to be investing on a monthly, quarterly, annual basis? Secondly, how much risk do we need to take in order to achieve our goals? And thirdly, how much time do we need to wait to allow us to realize those objectives? Because the reality is that when it comes to wealth, those are the only 3 levers that we have the ability to pull. And the majority of people are pulling the wrong lever. We can either put more money in, we can take more risk, or we can wait longer. And the lever that most of us pull, which is very, very naive, is the risk lever. Like, think about it this way, right? Let's say you've got $100,000 and you've invested it into a portfolio and you work your ass off and you actively manage and try and trade and buy and sell, and you are able to realize a 20% return. That's only $20,000. Like, how long do you think you would have to work in your business to make 20 grand? And for most businesses, it's not that long. So the real lever, the most significant lever, the one that is the most often overlooked, is the amount of contribution. Instead of worrying so much about the return, Let's get it in something that gives us a consistent and steady return and focus on the contributions. Build up the snowball, because the bigger the snowball as it starts rolling, the larger it's going to become. And this is just the fundamentals of compounding. So we need to work out, how do we set those 3 wealth KPIs? And our wealth KPIs are really important, because with our wealth strategy focusing on what we need to do in order to achieve our goals, that gives us an objective framework. It also allows us to assess the opportunity cost of different investments. Like, for example, if I said to you that you only had to get a 10% annualized return on your portfolio in order for you to achieve financial freedom in 15 years, and that was when you wanted to achieve financial freedom, do you think that you'd need to go and take a 20% return, where you could potentially jeopardize your ability to achieve that goal, which may result in you having to wait 30 years? For most people, they're going to say, no, I'm happy with that. If that's what I want, and that's the minimum the amount of risk that I need to take in order to get there, then perfect. Let's do that. So once we've got the simple strategy, we then need to work on our wealth KPIs. And the wealth KPIs are really revolving around 3 things. One is our allocation strategy. For every dollar that we invest, how do we allocate it? And the reality is that we've only got a handful of different asset classes that we can invest in. So the first one, we've got shares, both Australian and international. We've got property, which could be residential or commercial. We've got bonds or fixed interest. We've got government and corporate. And we've got cash. So what we firstly need to work out is, what is our asset allocation? And therefore, what are we going to do with that dollar to split it appropriately between the various asset classes? And this is a big mistake that I see many investors making. A prime example at the moment. And here's the thing. This whole coronavirus situation has resulted in us having some unprecedented situations. We're all sitting at home, we're all bored, and we've got unprecedented access to educational information, particularly on social media, of people giving their so-called, in inverted commas, expert advice around trading the share market. And there are a lot of people out there that are pretending to be gurus and were just lucky, like I was. Now, there's a lot of people who are day trading, playing the stock market, as it's often referred to, and they're doing so dangerously. Prime example is, there's a stock that is all of the talk at the moment called Nikola. Nikola is a hydrogen-powered vehicle company, has not produced any vehicles, has not made $1 of revenue, and has been taking reservations of their hydrogen trucks and other vehicles for no money down. They've had thousands and thousands and thousands of people express their interest, and no money down. The infrastructure of them building out these hydrogen fueling stations are huge. And we've seen this tremendous surge in stock price. Tremendous. For a pre-revenue company. Now, this is hugely dangerous. It is pure speculation. And there's many people that are speculating. And we saw very similar trends when the whole cryptocurrency boom happened a few years ago. That the speculation was that people were happy to pay the current price, which hugely overvalued, on the basis that they believe that somebody in the future would pay a higher price. That's fundamentally what is driving the behavior of this sentiment. Like, we're even seeing with Hertz, the rental car company who's declared bankruptcy. There's been this huge surge in the stock price. From less than $1, I think it's jumped to $5. And the greedy executives have just said that they were going to do a $1 billion cap raise and share issue for a company that is declared bankruptcy. Now, people who think they're smart, that are trying to invest in these kinds of companies, it is gambling. You may as well Go up to a slot machine, slide your money in, and hit the button. Because the reality is that is what you're doing with your money. Now, when it comes to investing the real way, as an entrepreneur, we define an asset allocation. And we set up an investment operating system that allows us to get that money into the market systematically, diversified across different asset classes, different sectors, different stocks, different types of investments that allows us to minimize our risk. Because fundamentally, there are only two types of risks when it comes to investments. There is the intrinsic value risk, whereby a company like Hertz declares bankruptcy and could be worth, in the matter of months, zero, like Lehman Brothers in the global financial crisis. And there's volatility risk. It's the roller coaster risk. Do you have the stomach to hold on during times of turmoil? And that's where most people get it wrong. They cannot they cannot bear the volatility associated with the market going up and down, which is the importance of us having a strategy. Because if you dive into these things subjectively, you see this as being an opportunity for you to manufacture wealth and essentially just kind of dive in, give it a crack, with the only objective of trying to, for that specific investment, to achieve a return. The likelihood of you being able to stick the course when times get tough because it's not linked back to a strategy is huge. It's very, very unlikely. I've seen it time and time again. Because it's not connected to a deeper purpose, it's not connected to a destination. When the going gets tough, then typically people cash in their chips, accept the loss, and that can set them back tremendously. As Warren Buffett's famous commandments. Rule number 1, don't lose money. And you only lose money when in investments if the asset becomes worthless or you sell out at a loss. You cannot stomach the fall. And this is the importance of us having this simple strategy. So let's talk about the 3 key wealth KPIs that you all need to set every single year. The first one is your allocation target. You need to work out of your surplus, how much should you be allocating to your wealth? We normally set as a benchmark for our clients to at least contribute 20% of your net income to your wealth creation. So for example, if your net household income is $100,000, you should be putting $20,000 a year as a minimum into your investment portfolio. Obviously, if you continue to increase your wealth, you continue to increase your surplus, assuming that your lifestyle creep is not in line with your income increase, which it shouldn't be, then that percentage should increase. The second wealth KPI that you should set every year is your debt reduction target. Whether it's good debt or bad debt, you should be working on chipping away at your debt to either free up your cash flow if it's bad debt, or to free up your debt ceiling if it's good debt, to allow you to continue to accumulate more good investments. We're going to talk more about that in a further podcast. And the third wealth KPI is going to be the appreciation of your wealth. So we should have a target. And although the target may not be achieved, that can also indicate how much more we need to be putting into the investment to get us back on track. Because ultimately, our ability to achieve financial freedom is going to be largely driven through our accumulation phase as our net wealth target. Is our net wealth appreciating at a level that as we get closer to a point where we actually want to achieve financial freedom, that we can then shift that net wealth into income-producing assets that will allow us to fund our lifestyle without having to rely on active income. So those are 3 wealth KPIs. Now my question to you is, do you have those KPIs defined? Do you know how much you need to be putting into investments every year? Do you have a debt reduction target? And do you have a wealth accumulation target, a net wealth target that you're trying to achieve every year? Because without those 3 things, you're flying completely blind. And it's likely that you're going to make subjective decisions that are either going to force you to sit on the fence and do nothing, or end up taking excessive risks that result in you taking knee-jerk decisions based on what investment opportunity looks good at the time that you see it. Can you see the issue with this? And this is where most entrepreneurs go wrong. This is where having a really simple wealth strategy, something that holds you accountable to making sure that you only take the level of risk required for you to achieve the outcome that's important to you. Because you're right, focusing on your business, growing and scaling it, improving the profits, increasing the cash flow, and then creating more personal income and then turning that personal income into wealth is the key to financial success. But without that objective framework to support you and without the investment operating system, you're going to be having knee-jerk decisions that is ultimately going to lead you astray at some point. Yes, you could get lucky. Many people do. But would you prefer to have a systematic approach to your wealth creation? Or would you prefer to have a wealth creation strategy that's driven by pure luck? I know what I want. And this is something that when I understood that experience that I had, where I was sitting in that boardroom and my heart had sunken into my chest, my trading account had gone to zero, I realized that I needed to find a better way. And that better way was very, very simple. I designed an investment operating system that allowed me to only have to focus on the amount of money that I put into my portfolio, which as I increased my income, as my business grew, I increased my allocation and it automatically invested my funds without me having to worry about it. At, in actual fact, a really, really cheap cost to execute, both by way of time and money. Because you've got to realize that your time is the most valuable resource. And the thing that is often most overlooked when it comes to investments is the amount of time required to actively manage. So I'm going to talk to you about a really simple system that allows you to turn your active income into personal wealth. It's a system that we use with all of our clients. We've used with thousands of people, tens of thousands who've read my book, and that I use personally. And it's allowed me to continue to grow and compound my wealth year on year and do the same for all of our clients. So let's talk about this. Let's talk about the function of investing and how do most people go about it. So let's talk about probably the most difficult investment that you can make is an investment in property. Now, let's say we wanted to go buy a residential investment property in Sydney. The process would be, we would go to a mortgage broker. We'd get that mortgage broker to get us a pre-approval. With that pre-approval in place, it would tell us the maximum amount that we can pay for that investment property. Once we have that pre-approval in place, we start searching. We'd start looking, okay, well, are we going to buy in the local area? Are we going to buy in a different area? Is there a research approach that we're following? For the majority of self-serving property investors, the answer is probably no. You go to open houses, things that look good, you speak to the agents, you get a little bit of an insight around the property, what's happening, what it's worth, what the vendor wants. You send the contract to your solicitor. If you like it, you submit an expression of interest. If that expression of interest is accepted, you do your due diligence. You get building and pest inspections. You do strata inspections if it's a unit or a townhouse. You do your research. You exchange contracts, assuming that you're happy. You put down your deposit. You wait and finalize to get your final inspections done. You get to settlement. It settles. Now the property's yours. Now, for the majority of most investors, they don't really have a process. It's what it feels right. Does the property look good? Does it have light? Is it on a quiet street? Is it in a nice neighborhood? Is it close to schools, hospitals, the shops? Aside from that, there's not a whole lot of research that most investors put in. This is where a buyer's agent comes in. A buyer's agent has a process. We've interviewed many buyer's agents and we've spoken to them about their methodology, and most of them have a framework that they follow that allows them to have a top-down approach to selecting properties. They look at the macroeconomics first. They work their way down to shortlist the suburbs that they believe are going to perform the best. They then do the micro-analysis and understand what is fair value in the current marketplace and how can they negotiate that property to be able to manufacture immediate equity. Now, for the typical, let's call it $10,000 or $15,000 that service costs, in the transactions that we've seen, more often than not, that buyer's agent's been able to negotiate multiple times more off the price than what you've paid them for the fee. Now, that is value. And if we've got a buyer's agent on our team and we've set a strategy that says, hey, we're going to buy an investment property every year or an investment property every couple of years, then all we need to do is just get our pre-approval in place, give the brief to the buyer's agent, and get them to go and do the work for us. That is an integral part of your investment operating system. Now, the second type of investment that many of us should be making or might be making is investing in the stock market. So most people are going to invest in the stock market in one of three ways. They're going to go and buy the stocks directly, they're going to buy an exchange-traded fund or an ETF, or they're going to buy a managed fund. Now, the direct stock picking, they go and do some research. They go, okay, well, what are the companies that I want to have access to? I'm going to look at the financial statements. I'm going to look at the volatility. I'm going to look at the 52-week averages. I'm going to look at the PE ratio. I'm going to look at the beta to the market. And I'm going to look at what the price ranges are, what the trading volume is. I'm going to maybe look at some other independent reports on Morningstar or one of these other types of research sites. And then I'm going to make a decision. Okay, well, when do you buy more? When do you sell? What other stocks should you be putting into that portfolio to ensure that you've got a robust and well-balanced investment strategy? Do you invest every month into those investments? If so, in what volume, what percentages? How do you make sure that you're not overspending on brokerage by bundling your purchases together? When do you exit? When is a stock overvalued? And then once you've exited, what do you buy? It becomes a very, very complicated and time-consuming process. Now, the next option is exchange-traded funds, and there is a wide variety of exchange-traded funds. You can get sector-specific funds, you can get total market funds, you can get diversified funds, you can get ethical funds. Now, the universe is so huge, there are thousands, if not tens of thousands of exchange-traded funds out there. Which ones do you choose? And for the same allocation strategy as your direct stocks. When do you buy them? How often do you exit? Now, the third strategy of managed funds. Well, many of them can be either actively or passively managed, which has a big difference in terms of price. Which ones do you select? How much do you allocate? What's their performance like compared to the market? What is the net performance after fees and taxes? This seems really confusing, right? Now, there is a very, very simple way that we can utilize all of these asset classes into an investment operating system that can essentially be automatically allocated for us via a direct debit once a month. And this investment operating system is something that we deployed for our clients years ago, something that I've been using for almost a decade now. And the only thing that I need to focus on is reviewing how much I contribute on a quarterly basis. Simple, right? I look at setting an income target in the business, I work towards that income target, I pay myself more, and I increase my investment contributions. And by doing this, it allows me to systematically advance my wealth whilst focusing almost my complete attention on my business. And this is the way that wealth is created as an entrepreneur. This is the investment operating system and why it works. And by having this in place, it's going to make life a whole lot easier for you. So you can be smack bang in the middle of sitting on the fence, but not being super aggressive trying to actively manage every single aspect of your wealth. At least until we set a foundation of wealth and we get to a point where in our business we can either be in that leader or that entrepreneur stage. and have that free time where we can actively manage our wealth and treat it as if it is a business itself. But the reality is I've got many clients to that stage, and because the investment operating system is so simple and is so effective, that they really have no desire to actively manage. Sure, they might have a project that's a bit of a passion project. They might do a subdivision or a small duplex development, or they might do something along those lines, maybe a renovate for profit project. But the reality is the majority of their wealth is driven by the investment operating system and is set and forget. You see, investing is a science. And if you're trying to treat it like an art, that you're actively managing it, trying to outsmart the market, you're going to get burnt. It may not happen today, it may not happen this year, but at some point in time it will happen, and I assure you it'll happen when you can at least afford it to happen. So be smart with your investments. Get educated. Read the right books. Implement the right strategies. Have the right mentors that can help you take the least amount of risk required for you to achieve the goals that you're working towards. So I hope that this has been insightful for you guys. If you've enjoyed today's podcast, if you'd love to have a conversation around how we can help you, please feel free to get in touch. I'd love to have a chat, help you map out your wealth game plan for the next financial year for you to crush your goals. I'm really excited to be producing more of this content for you. And hey guys, if you're interested in any particular topics that you'd like us to cover on this podcast, if there's any specific guests that you'd like us to interview, please feel free to get in touch. We'd love to have a chat and see how we can continue to improve this format to help support you in pursuit of financial freedom. This is Jackson Milan, the Wealth Mentor. Look forward to catching you next time. Cheers.